Hello and welcome. So today we are going to tackle the stock market. And our goal is pretty simple, really. We're going to demystify all those key terms you hear thrown around so you can actually understand what everyone's talking about. You ever hear phrases like PE ratio or bear market and your brain just kind of goes fuzzy? Yeah, you are definitely not alone. It can seriously feel like it's this whole secret language, almost designed to keep regular people out. But don't you worry, we are about to crack the code. And to help us out, I want you to meet Stickman. He's going to be our fearless guide through this whole thing, sort of living out the highs and lows of being a new investor. Now, just a quick heads up, this is all for educational purposes, okay? This is not financial advice. Think of me as your friendly guide on the side. So let's get into it. Okay, first things first. What in the world is a stock? Well, probably the easiest way to wrap your head around it is to think about it like a slice of pizza. A single stock is really just a tiny, tiny piece of ownership in a company. When that company does well, your slice gets more valuable. If it doesn't do so well, that slice might shrink a little. But here's the thing, not all slices are created equal. There are two main types you really need to know about. So you've basically got two main flavors, common and preferred. With common stock, you get voting rights, you actually get a say in how the company is run, but dividends, those little payouts, they're not guaranteed. With preferred stock, you usually give up that vote, but in return, you get more reliable dividends and you're first in line to get paid if something happens. So it really boils down to a choice between control and consistency. Okay, so we get what a stock is, but where do you actually buy and sell these little pizza slices? Well, that all happens on the stock market, a place that, believe it or not, is driven just as much by human feelings as it is by spreadsheets. In the US, the two biggest players you'll hear about are the NYSE and the NASDAQ. Think of the NYSE as that classic old-school auction house. It's got a real physical trading floor, and it's home to a lot of big, established companies. NASDAQ, on the other hand, is the sleek, all-digital kid on the block. There's no floor, just servers, and it's famous for being the home of all the tech giants, like Apple and Microsoft. So with literally thousands of stocks out there, how do we get a sense of how the market is doing as a whole? That's where something called an index comes in. An index is basically just a report card. It grabs a specific group of stocks and tracks them to give us a quick snapshot of how that part of the market is feeling. Now, the three you're going to hear about constantly are the S&P 500, which gives you a really broad look at 500 of the biggest US companies. Then there's the Dow Jones, which is more focused. It just looks at 30 huge industrial giants. And then you have the NASDAQ Composite, which is packed with tech stocks and is usually a bit more energetic. All right, let's talk about the market's personality, its mood swings. See, when everyone's feeling optimistic, confident, and prices are generally climbing, that's what we call a bull market. Think of the bull charging forward. But when fear starts to creep in and prices are falling for a while, that's a bear market. The bear swipes everything down. And that brings up a really crucial point. You don't fight the trend. As our buddy Stickman found out the hard way, trying to swim against the current of a powerful bear market, yeah, it's a recipe for disaster. It's much smarter to just understand what kind of market you're in. Okay, so we're getting a handle on the market. But how do you figure out if one specific company's stock is a decent buy? This is where we get into just a tiny bit of math. But don't worry, it's not scary math. We're talking about valuation ratios. And this table here breaks it down perfectly. The PE ratio, that just tells you how much you're paying for every single dollar the company makes. The PB ratio, that compares the price tag to what the company is actually worth, what's under the hood. And the dividend yield, that's what Stickman likes to call his snack ratio. It's the little bit of income you get back just for owning the stock. But here's a little word of caution, courtesy of Stickman. One number by itself never ever tells the whole story. A low PE might look like a total bargain, but it could also be a huge red flag that the company's in trouble. Context is absolutely everything. So now that we know how to size up a company, let's actually open up the investor's toolkit and look at the strategies people use to navigate these sometimes choppy waters. Okay, first step is market cap. It sounds fancy, but it's really just a way of saying company size. Large caps, those are the skyscrapers of the stock world. They're huge and stable. Mid caps are your steady growers, and small caps are like those tiny independent coffee shops. They could become the next big thing, or they could go out of business next month. And that right there is exactly why balance matters. Stickman's little misadventure just goes to show you the risk of betting everything on those high-growth, high-risk small companies. Having a mix of different sizes is usually a much safer way to go. This brings us to probably one of the most important words in all of investing. And I just love this analogy. If the market's constant ups and downs, its volatility is like a wild roller coaster, then diversification, that's your seatbelt. It's what keeps you from getting thrown out of your seat. I mean, this story just drives home that old saying, right? Don't put all your eggs in one basket. Stickman learned that one the painful way. Diversification just means spreading your money out across different companies and different industries. So if one part of your portfolio takes a nosedive, the others can hopefully keep you afloat. So you might be thinking, okay, that sounds smart, but how do I do that without buying a million different stocks? Well, Stickman calls this the lazy genius method. Things like index funds and ETFs let you buy a whole basket of stocks at once. So an S&P 500 index fund, for instance, gives you a tiny piece of all 500 companies in that index. Boom, instant diversification. All right, so we've covered the what, the where, and the how. But honestly, the biggest challenge in investing isn't usually the math. It's taming your own brain, managing your emotions, and getting into the right mindset. And this slide really shows you the two extremes of the market. On one end, you have your blue chip stocks. These are the massive, stable companies that are like the bedrock of a portfolio. On the other end of the spectrum, penny stocks. Sure, they're cheap, and they whisper promises of huge returns, but like Stickman says, they're usually just lottery tickets in disguise, and most of them don't pay off. And you know, that really gets to the heart of all this. Success in the stock market isn't about getting rich overnight. It's about patience, it's about perspective. It really is a marathon. And yeah, there are going to be some scary hills along the way, but time is your absolute greatest ally. So, from pizza slices to seatbelts, we have covered a ton of ground today. And as we wrap things up, I'm genuinely curious. Which one of these terms finally clicked for you? Which one finally made sense? Because just thinking about that, well, that's the first step to becoming a more confident and knowledgeable investor. Thanks so much for joining me on this explainer.